Hey everyone, Couch Investor back with the second earnings report of this evening. We already touched on Intel. That video will be in the top right corner. Now let's talk about Enphase. Unfortunately, I have not very good news to report. The stock is down 16%. Outlook was very ugly. And last quarter, if you remember, they authorized that $1 billion worth of buybacks. A lot of investors were thinking maybe they've been buying back a lot of shares already this quarter since the stock has been down quite a lot. Well, now it's down even more. Well, they didn't really buy that much, but hey, now that the stock is again 16% cheaper, maybe they'll buy more aggressively in this quarter. But I do want to remind those that still don't know or that forgot that we already knew this was not going to be a good quarter based on SolarEdge preliminary announcement. Remember, they said here, during the second part of the third quarter of 2023, we experienced substantial unexpected cancellations and push-outs of existing backlog from our European distributors. We attribute these cancellations and push-outs to higher than expected inventory in the channels and slower than expected installation rates. In particular, installation rates for the third quarter were much slower at the end of the summer and in September, where traditionally there is a rise in installation rates. So, their revenue expectations went from $880 to $920 million to now $720 to $730 million. Non-GAAP gross margin is now expected to be 20.1 to 21.1% compared to 28 to 31%. So we knew that bad news was coming for Enphase. By the way, when this went out, Enphase got hit as well. So some might say, oh, this isn't fair. They pre-announce and the whole industry goes down, and then Enphase announces and it goes down even more. Well, unfortunately, we are in a market where you can get penalized twice on the same thing. And just an FYI, I showed you this before. Analysts were also expecting this to be still affecting Enphase in this quarter and probably in the next 2 to 3 quarters as well. We had an analyst at Scotiabank say this here: it is difficult to see a path to marked and sustained improvement in the macro environment over the next 2 to 3 quarters. The analyst also noted, and this is more to SolarEdge, that while the company has enjoyed growth in Europe over the past several years, the destocking cycle seems similar to US, though lagging by a quarter or two, and that's probably why we are seeing these numbers with Enphase. So, what exactly has happened here? Well, first up, they reported quarterly revenue of $551.1 million, which, yes, is a bit in their own guided range. Along with 48.4% of non-GAAP gross profit margin, they shipped 3,905,239 microinverters, or approximately 1,585.6 megawatts DC and 86.2 megawatt hours of IQ batteries. Now, you're going to see the numbers. Of course, they are worse quarter over quarter, year over year, and so on and so forth. But in my opinion, this is still a company that will benefit from the adoption of energy storage, solar roof, etc., etc. Right now, we're just seeing pain across the board. So, GAAP gross margin 47.5%, non-GAAP 48.4%, and that's inclusive of net IRA benefits of 2.6%. And for GAAP operating income, $118 million. So again, this company is profitable. Non-GAAP operating income of $167.6 million. GAAP net income of $114 million. Non-GAAP $141.8. As for GAAP diluted earnings per share, 80 cents. Non-GAAP $1.02. Then here, still very important in my opinion, is the free cash flow still being positive, $122 million, which means they ended cash equivalents, and marketable securities of $1.78 billion. So definitely very sustainable business. Even in a down cycle, if they want, they can buy back more of their shares. It just remains to be seen what they think is best for the business. So this is the fuller picture here if you want to have a look at all the numbers compared to last quarter and the same quarter last year. Now, if you enjoyed this video so far, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and a pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, they do give us a bit of an explanation here. So with regards to revenue, they say here that due to macroeconomic conditions, our revenue in the United States for the third quarter decreased approximately 16% compared to the second quarter of 2023. Our revenue in Europe decreased approximately 34% compared to the second quarter due to high inventory at our distribution partners, along with a softening in demand in our key markets, the Netherlands, France, and Germany, just as we've spoken about earlier in this video. Now here they talk a bit about the share repurchases. So in July 2023, our board of directors approved a share repurchase program with authorization to purchase up to $1 billion worth of shares. In the third quarter, we repurchased 846,648 shares of our common stock at an average price of $129.92 per share, so still pretty high compared to the price it is today. So that's approximately $110 million, so they still have $890 million to spend on buying their own shares. Maybe they'll be a bit more aggressive in Q4. Here they talk a bit about the announcements, the improvements that they made with regards to microinverters, battery shipments. We've talked a bit about that in previous videos, but hey, if you want to pause the video and look at it, here it is. Then, with regards to fourth quarter outlook, not a good picture. So revenue to be within the range of $300 to $350 million. That's a $200 million decrease quarter over quarter, by the way. So this includes shipments of 80 to 100 megawatt hours of IQ batteries. Gross margin to be within the range of 46 to 49%, with IRA benefit of 38 to 41% before net IRA benefit. Non-GAAP gross margin to be in the range of 48 to 51% with net IRA benefit and 40 to 43% before the net IRA benefits. And yes, non-GAAP gross margin excludes stock-based compensation expense and acquisition-related amortization. Now, if we look at the stock and its valuation, PE, EV to EBITDA, price to sales, price to free cash flow, yes, the stock is down 16.3% at the time of making this video. Year to date, it will be down more than 65%. Yes, compared to its 5-year mean, the stock is now extremely cheap. But remember, beforehand, during those 5-year period, they had a lot of momentum, huge tailwinds for the business, which right now are headwinds. So although it looks extremely cheap, right now with all the numbers that we've seen, with revenue coming down quite a lot, don't let just these metrics decide or make that decision for you. There is a reason why some stocks are extremely cheap compared to its 5-year mean. Now again, I repeat myself, it can be that we're near a bottom, that we are now at peak fear, doomsday scenario, etc., etc. And yes, you look 5-10 years from now, you're like, Enphase at $80, what a joke. Could be, but as most analysts are expecting, as we've seen from the companies itself, right now we are in a tough environment. And so if we look at the graph, since the last time they reported earnings, the stock is now down close to 55%. We are slowly but surely entering that area where previously, back in 2020, there was a phase of consolidation a little bit. This could be between $60 and $80. I know it's a big range, but I mean, right now we are also, by the way, oversold. First time in a long time. This is on the weekly chart. Again, we can be oversold for quite a while, as we've seen with other stocks as well. But I mean, oversold, I've never or I rarely seen a stock where you buy when it's oversold and it performs badly in the future, especially if it's already free cash flow positive, if it still has good margins as well, and it operates in a pretty good industry for the long run. Right now, tough environment. So that will be it for this video. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.